Good morning. Chirasi proudly present banking series, bank borrowings and security, presented by Rajendran Sivaramapillai, formerly advisor banking on major bank fraud cases, Nago. This is only an awareness video to general public and bank customers to familiarize with banking terms connected with borrowings from bank. Many of us, we are aware, basically banks lend money for two main purposes. One is productive purposes in creation of assets. Number two, personal purposes against other assets. Now let us see what is consideration. As per the legal term, it is the mutual benefits for those who enter into contract. For example, banks lend the money, customers use that money for generating income. So it is consideration for both which mutually benefits. And now the second important terminology we often hear is what is a charge? Sharing of interest or our rights in assets is called as a charge. Now, as we know, there are various types of security. Number one, prime security. Prime security means assets created with the help of bank loan. Example, land development loans, housing loans, loans for purchase of machineries and stocks as working capital assistance, where the assets are created with the help of bank loan. Number two is the collateral security. This means the assets are given as a security to avail a loan from bank. The assets given as collateral security need not be financed by the bank. It is in our own title with clear title. Now, I earlier mentioned we give a charge is a part of the interest is shared with the banks. Now, what are our interests or rights in assets? Number one, right to generate income. With the assets financed by the bank, we try to generate income for us. So, this is the first fundamental right, right to generate income. Number two, right to create other assets. With the surplus income created, we have got right to create other assets. Number three, right to seize, dispose and sell it. In case we do not want to continue, we have got the right to dispose it, sell it and use that money to settle the dues. Number four, right to pay all statutory dues like property tax, water tax, electricity maintenance and land revenue tax. Number five, right to insure the assets. That means during the tenure of the loan, it is our right to keep the assets adequately or comprehensively insured. Number six, right to maintain the assets financed by the banks properly. Even though these rights are our rights in our interest, we share the third important right, that is right to seize, dispose and sell it. We share it with the bank. We transfer this right with an agreement to the bank. That means this right to dispose and settle the dues has to be with the concurrence of the bank. So we transfer this right to seize and dispose. So this is called a charge is created by transferring this right. Once banks exercise their rights to seize and they have seized the assets means the responsibility to insure the assets continuously and right to maintain the assets till it is disposed lies with the bank. Now let us see what are all the various types of charges. The first one is mortgage. Number two is hypothecation. Number three, pledge and lien. Number four, assignment. Next we will see in detail what are the implications, what are the differences between these four types of charges. In the case of mortgage, mainly mortgage is taken for immovable and permanent assets. Example, land and building. Number two, flats and undivided share of land Number 3, fixed permanent machineries. This mortgage is of two types. Number 1 is the equitable mortgage. This is otherwise called as simple deposit of title deeds in notified centers by government every year, followed by registered memorandum. Earlier, it was only a simple agreement depositing all the relevant title deeds along with other documents to the branches in the notified centers, but because of large number of frauds, now a registered memorandum has to be ensured with sub-registrar's office and the limitation period is 12. If for long-term loans like housing, when the limitation period of 12 years expires, it has to be redeposited in the type. Number 2 is the registered mortgage. Limitation period for a registered mortgage 30 years. Now, the documents registered for mortgage. Number 1, the original deed. This may be a sale deed or a gift deed or a partition deed or a settlement deed, etc., including agreement for sale. Normally, when a land is to be purchased, we first enter into agreement for sale, and with a time duration of 2 to 3 months, we enter the sale deed. Now, this agreement for sale also contains the advance amount paid and the balance to be paid. And this, the full payment is received is to reflect in the original sale deed. Now, the second important document is the legal opinion from bank's approved panel lawyers. Number 3, valuation certificate of bank approved panel valuers if it is already constructed house or building. Number 4, undertaking letter from builders. Number 5, no objection certificate from housing society if formed. If not, an undertaking to provide no objection certificate when the housing society is formed. Number 6, sad certificate of the housing society. Number 7, nil encumbrance certificate for 13 years because the limitation period for a equitable mortgage is 12 years. We have to ensure that there is no encumbrance. Eighth one is the land tax paid. Receipt for the land tax paid. Number 9, completion certificate. And number 10, property tax, water tax, and charges paid. Now, banks use some terms for calculating the value of the land and building. One is current market value, CMV. Sometimes banks extend special schemes giving 50% of the securities offered based on current market value. Number second value is the forced sale value. Whenever due to non-payment, if banks have to sell those lands, then they consider what will be the forced sale value as well as the distress sale value. Before financing also, they also consider the guidelines value prescribed by government of Tamil Nadu. So, in the case of mortgage, the agency involved are borrower, bank, and sub-registrar office, and all the three are connected by mortgage deed. It is to be remembered, once the loan amount is closed, we need to cancel this mortgage deed and get the encumbrance removed or get the loan closed. Number 2, the hypothecation is the agreement entered between borrower and bank on a non-judicial stamp paper or on the agreement forms printed by the banks. Hypothecation is normally taken on movable assets like vehicles, machineries, stocks in trade like raw materials, work in progress, and finished goods, other current assets, non-current assets, and intangible assets like goodwill and brand. The main principle in hypothecation is the assets are in the custody of the borrower. They can put use for the development of the business and generation of income and pay the monthly equated month installments regularly. So hypothecation is a very simple process whereby the rights to sell the machineries, the rights to sell the movable assets, stocks in trade, or other current assets, we transfer it to the bank with this agreement. In the case of agreement, if the borrowers do not pay the monthly installments regularly, and if there is a default, and if that default becomes more than 90 days and borrower has not responded to the advice of the bank to regularize the account, then banks can exercise the power to seize the vehicles or seize the assets, and following certain norms prescribed, like giving minimum 30 days notice to the borrower their intention to sell the seized products unless the account is regularized. Number 2, publication in papers. And number 3, open public auction. Here in the auction, bank staff and their family members are not permitted to participate. So in the amount received in the auction is adjusted to the loan account, and if there is any excess, it will be returned to the credit of the borrower's account. The principle is, in the case of the major difference is, in the case of mortgage, the court permission is required unless and otherwise. If it is under SARFAESI Act, the government through the Act has given some special powers to banks to follow up some procedures to give the notice, and then they got the rights to dispose the assets also. Now, the third form of security is the hypothecation in the form of pledge. Whenever we take a jewel loan or agricultural loan against jewels and even deposits, the original jewels on deposits are pledged with the banks, and this is also an extended form of hypothecation. These are mainly two types. One is the general lien, and number 2 is particular lien. Lien means this is available for banks only as they can mark their lien on these deposits before under jewels or deposits in view of the dues in the. Number 2 is particular liens. It is a security only for that loan or act. A simple example is, if you give your watch for a repair and the repairer charges 500 rupees, until and unless you pay that 500 rupees, he has got a particular lien on the watch. In case you fail to pay the money within the stipulated time, he has got the right to dispose that watch. But before disposing the jewels or before taking action to recover the dues, their right to dispose that, they have to follow certain procedure. A registered notice as per the last declared address in the application form should be followed with an acknowledgement letter, and if it is returned, it should be kept safely along with the doc. Then they have to publish that if the borrower fails to pay the money within 30 days, they can go for public auction of the jewels. Similarly, deposits, they can, before the maturity date, they can adjust and recover the dues. So this right is available. And please remember, when you are given a personal guarantee, banks have got a right on these deposits, even though you have not borrowed, but you stood as a guarantor. This right is called as a general. The last one is the assignment. That means in the books of Life Insurance Corporation, Post Office, and in respective companies regarding receivables, they can make their assignments like life insurance certificate, national savings certificate, and book debts and receiver. That means borrower and bank, they write to LIC or post office or company and firms, and in their books, the title of the receipt is transferred in the name of the bank. So once the loan amount is closed, it has to be paid back, the reassigned, then only borrower has the right to get the maturity amount. And the last one is the personal guarantee. Many times for the loan given to the company or partnership firm, the individual directors or the partners, they give their personal guarantee also. As per section 124 of the Contract Act, if a person, one party, promises to save the other from loss caused to him by the conduct of the promiser himself or by the conduct of the any other person, is called a contract of indemnity. And very important is, this is coextensive of the principal borrower. Borrower extends into an agreement or contract with the bank. That this coextensive is very important because cannot question whether to it is completely bank's right either to proceed against the borrower or to proceed against the guarantor to recover the dues. And once the guarantor has settled the money, the guarantor enters into the shoes of the creditor. He has to file a civil suit against the original borrower to recover. These are some of the examples.